Good afternoon, and welcome to the Fall 2025 Linneman Associates Capital Markets webinar presented by Linneman Associates and me, Bruce Kirsch, founder of CEO and CEO of REFM and head of real estate software at Actis AI. As always, we're pleased to have an insightful program for you today, which will be presented by Dr. Peter Linneman, founder of Linneman Associates, which, for those of you who do not know, is a strategic and investment analysis advisory firm. We're using Zoom, and there are a couple of housekeeping items that we'll do real quick here. On the audio front, all the participant audio is muted, meaning we cannot hear you as a participant. That's by design, and that's going to remain the case throughout the webinar. If you're attending by computer, take a moment just to reacquaint yourself with the control panel elements. We will be showing the slides, but I'm going to put a link in the chat now and then also a couple of times as we go through to allow you to download them as well. You don't need to download them, but you're certainly welcome to have them for future reference. As always, we're going to reserve some time at the end to answer questions. Feel free to send your questions through at any point. Make sure you click the Q&A button and then hit enter after you type your question. And if you get disconnected at any point, just reconnect the same way you did originally. If you're registered, you will later today get an email with the link to the replay and the slides. And the video is also going to be posted on the Linneman Associates website later today and to YouTube. And without any further ado, I'm introducing the man of the hour here. I can't believe it's already almost Thanksgiving. Peter, how are you doing today?
Terrific, terrific. By the way, with that, happy Thanksgiving to you, Bruce, and to all our listeners. And hope the holiday season is joyous and wonderful. And as always, I encourage people to think of those a little less fortunate than us. Be kind to be generous. Um, let's start with the first slide, which is sort of a summary of what's happened in the since our last session. In case you didn't know, there was a government shutdown. I don't know if any of you heard that. It was kept kind of quiet. We had written about the fact that economic shutdowns are not economically important events. They're a lot of theater. My brother Doug said, well, this was a sort of a long play. In the end, it was full of sound and fury, and as Shakespeare said, signified nothing. But it did leave us, all of us, flying blind without the data we usually get for about 31 days. And it's coming back online as we go. And in fact, we'll mention a couple pieces of data. It felt like much longer. We were left only relying on private data that we track rather than BLS data. But nonetheless, we've been flying blind. I'll talk to you more about the economy. But the data that has just come out, whether it's unemployment insurance claims or job growth, seem to suggest that while the economy has slowed versus the first quarter of the year, it is still growing. And that'll become a continuing theme. The Fed has finally cut interest rates. They haven't cut them enough, but it's a start. I believe they'll cut them another 25 basis points next month. I believe they would have cut more last month had it not been for Trump. Imagine you value your independence. Imagine you're on the fence between 25 and 50 basis points. Imagine that the Trump administration, right or wrong, is trying to get rid of one of your members. And the morning of your meeting, a new appointee, a temporary appointee of the Trump administration shows up and says 50. I think human nature says, okay, to show you we're independent, 25. And so, but they are cutting, and that will help. It will particularly help the auto industry and manufacturing, and obviously it will help developers. Um, One of the mysteries is how is the economy growing, um, given the increase in tariffs? And I really should have had these two bullet points flipped. If you simulate based on where people bought from, what they bought, et cetera, people come up with the tariff has gone to about 16 to 18%. That is 16 to $18 on $100 of imported goods. And that would be up from $3 per $100 of imported goods. However, this is the point, the average tariff is only up from $3 per hundred, 3%, to $6.50. When you look at actual tariff revenues and divide that by actual imports, and you say, well, how can the simulated rate be 16 to 18%, but the actual rate is only 6.5%? And the answer is people react. And give you just one simple, trivial kind of example. Imagine you were a home builder, you're buying screws from Canada. The screws you're buying from Canada are a penny cheaper than screws you can get in the US. I'll just take that as an example. um, they put a 400% tariff on screws coming in from Canada. The simulated would pick up that 400% as if you're still buying screws from Canada. But if it's a penny more expensive to just buy them from the US, you're going to buy them from the US, and those tariffs aren't really going to be very effective. So people adjust. And I would remind people that recoveries tend to last 6 to 8 years, and we are still only in the about fourth year. Okay, let's go to the next slide. I'm going to use S&P 500, not so much from a valuation point of view, but from a sentiment point of view. Um, in the long term, it does show value. In the short term, I think it shows as much as anything are people optimistic or pessimistic. And we've recovered from earlier this year. That's the red line, earlier this year. And we're up. Now it's bouncing around. It's not like it's unambiguous, but the capital market sentiment is definitely improved, and it's showing in the S&P. Go to the next. Is our values too high? And you hear this, and you hear the multiples discussions and so forth. But when you actually look at actual money flow into real estate, into manufacturing, into a lot of areas, money flows are still below average. So, for example, real estate transaction volumes are well below average. That's not a lot of money flow. If you do value stocks or so-called value stocks or mid-market stocks, they're not richly priced. In fact, if anything, their pricing is low by historic benchmarks. And there's about 20 stocks, you could argue, is it a bit fewer, a bit more, that are linked to AI. And they are why, quote, the stock market is high. And when it's a weighted average and it includes those that are really highly valued, um, it pulls the whole market up, even though most companies are not up. And the bet is AI what I would call a jump improvement in productivity growth? If so, those valuations are fairly reasonable. By jump growth, we get normally about 1.5% productivity growth over the long term. And imagine you believe that AI takes it from the normal 1.5, but for a decade or two makes it 3%. And you think that the benefit of that jump from 1.5 to 3% for 20 years goes to a handful of companies, those companies are going to be fabulously uh, um, valued and should be. On the other hand, if AI is just one more way that the normal 1.5% productivity growth occurs, those 20, if you will, are overvalued. And my gut is that AI is just going to be the way the normal 1.5% or so occurs. And you have to remember that included electricity, clean water, computers, on and on, right? And yet, over all those innovations, it was only about 1.5% over the long run. So, but time will tell. And this is a new game. Go to the next. We hear a lot about the federal deficit. Um, I'm not a big fan of government spending, be that as it may. We could plot the federal deficit back to when I was born in 1951. And basically, since 1951, we always run deficits. Um, Secondly, since 1951, people continually say we cannot continue to run deficits or the economy will melt down. And you can see here we've run it for 22 years, over which the economy has grown quite nicely, but we could take it back. So we do get it. And when you look at it, the issue is not taxes. The issue is spending. And I use France as the example. France basically collects half of the economy in tax revenue, um, and yet they still run big deficits. If taxes were the problem, not being high enough, France should have a huge budget surplus, but they don't. It's about spending. And you're not going to solve it by taxes. We've had high taxes and low taxes and in between, and we've had all kinds of other taxes, and we run deficits. If you go to the next chart, these deficits accumulate an outstanding US government debt, and it is large. And there are three charts shown here, three graphs shown here. The top one is headline US government debt as a percent of GDP. And you can see, yes, it's up. It's up over 100%. It peaked early this decade and has fallen but it's still very high by historic standards. The next chart, the one in the middle, the kind of reddish, nets out debt held by the federal government and the Fed, which is effectively a branch of the federal government. And you see that the debt outstanding gives a very different picture. Same pattern, but a very different picture. Um, Namely, it's up, but not up nearly so dramatically, and it's well below 100% of GDP. And why do you take out federal government debt? Why do you take out debt held by the Fed? And that's because the government pays that debt, but the government receives that payment on the debt. So it cancels. It's an intra-company account. And people don't realize how important it is to take that out, including the Fed, because the Fed hands over any profits they have at the end of the year or losses to the Treasury. The bottom chart is what is our real debt to outsiders? Because remember, much of that debt, about two-thirds, just roughly, is held by US entities. So US Treasury is paying it to US entities. It's not leaving the US. It's still in our system. It's not necessarily neutral in our system who gets it and who pays it. But we pay our taxes, we pay the interest on it, and we receive it collectively. The bottom is the debt held by foreigners as a percent of GDP. And you can see, and that's a real liability for the country. That's a real liability. But you can see that has not grown over time. And in fact, it's tailed off over time. The main buyer of federal debt over the last 12, 13 years has been the federal government in the form of the Fed. So it's a very different picture. I'm not saying it's good or bad, it just is, and it's important to understand. Go to the next. How long can these deficits continue? I keep getting asked. And I say, my entire life, people say, oh, we're on the precipice. And the answer is, it's gone on basically for 74 years of my life. And it's gone on before that as well. But I'm just going to take my lifespan as the marker. We have about $170 trillion in household wealth, and we have about 25 trillion in outstanding federal debt. So the net balance sheet of us, ignoring off balance sheet liabilities of the government and ignoring assets of the federal government like national parks, oil reserves, bandwidth, etc. So if you ignore those, you come up with a net wealth of about $145 trillion. That's up from 540 billion when I was born, which is to say that wealth has grown at just under 8% a year CAGR over my lifetime. And a way to think about it, just can it go on, is we have 145 trillion in net of federal government debt, wealth. If it grows by 3%, it will raise wealth by 5.1 trillion in a year. The federal budget deficit is about 2 trillion. So if you say, okay, we have wealth grow by 3%, we add 5%, but we take on the debt of the federal government of 2 trillion, wealth would still grow by 3.2 trillion. Another way of saying it is, not only do we have the original 145 trillion to leave to our children and grandchildren, after a year of that wealth growing by just 3%, and remember the CAGR was just under 8%, the wealth we can pass on to our children, net net, grows by just about $3 trillion. We're not robbing our grandchildren with this debt. We're just giving them a slightly smaller inheritance. And that's a big difference. And it's why it can go on as long as we keep generating wealth. And that's the real key. And think of your real estate. Can you have more debt on your property today than in 1951? And the answer is, of course. Why? Because the value of your asset is up. And just think about that applying to the economy. So, yes, we've grown our federal debt enormously, but we've grown our wealth far more enormously. And our bequest to future generations is enormous and still growing. So it's a misnomer to say we are robbing our grandchildren. That is not to say we're spending the money efficiently. It's not to say it's not harming the economy by wasteful spending or distortionary taxes. But this is why it's gone on my whole life and can go on forever. One other thing, go to the next, is to remember we pay about $880 billion on federal debt outstanding. But the federal government and the Fed together receive 270 billion of that. So they pay it and they receive it. US entities receive 381 billion. Only 214 billion, which is about 7 tenths of GDP, 7 tenths of percent of GDP, drains out to foreigners. And we don't want to pay that off because we'd like to have the option to stiff them. Just go to the next, and it was an interesting exercise I did, which is understand the US was the richest country in the world by far when I was born. Um, real GDP, real GDP per capita was only 24% of what it is today. That is adjusting for inflation. GDP per capita was 24% of what it is today. It would be as if the richest country in the world today was Bulgaria or Chile, which we don't think of as rich countries. That's how poor the country was, and versus how much wealth we built. Give you another sense, 25% of US households did not have access to an indoor flush toilet when I'm born. Um, Not surprisingly, as we've grown staggeringly richer over the course of my lifetime from all the things we've created, profligacy has increased. And it's increased at every level. It's increased in private consumption. It's increased in public expenditures. I'm not even arguing it's good, but I think it's fair to say individuals are more profligate in their private decisions than they were 74 years ago. And the government is much more profligate because we have more money with which to be profligate. So it's not as horrible as you think. I'm going to go through the next reasonably quickly. These are not updated because we haven't got updated data yet. But the next chart is real GDP. The light blue is the trend through the 2010s. And you can see real GDP is well recovered from where it was in 2019 in the COVID shutdown, but it's still a bit below. And we still have a bit of pent-up demand, largely in manufacturing, auto, and housing. So I think there's still good tailwinds out there. Next chart is employment. And this is not updated because the number came out this morning of job growth was 119,000. I was on the phone with my friend Anoop Dave. As the data came out, he said, the data's out. How much was the job growth? And I said, 120,000. And he says, you're wrong. It's 119,000. So we're still growing. That's not a staggeringly good rate of growth. It actually is eerily on target with the rate of growth I wrote about when the tariffs first were being discussed, because I thought the tariffs would go from about $3 a hundred to about $5 a hundred on average. And that would slow growth down, and it would slow it down to about 1,000,004 jobs a year, which is roughly the pace that this last month would be. Tariffs a little higher than that, so the last few months slower, but we're still adding jobs. Um, but with selectivity. Go to the next. Weekly unemployment insurance claims came out today. We hadn't had them for a month. They come out every week. This is not based on a sample, it's the whole data. And it came out at 224,000, which is a very good number. It's consistent with where we were. So there's solid labor market there. Unemployment rate came out, and it is basically unchanged from where it had been. So while we held our breath while we didn't have data, not horrible things happened, not wonderful things happened, but it kind of continued, which was our sense of things. We go to the next chart. We still have this enormous shortage of single family housing. That's what has driven home prices upwards since 2011. It will continue to drive them up. It's interest rate being low added fuel to the fire, but the fire is this shortage. People want housing, they want single family housing. It takes them longer to save. People who have a mortgage locked in are hanging on to it. They're not selling it. There's a shortage of used homes, if you will. And that particularly hits lower middle class in terms of income, because they're the ones who tend to buy used homes rather than new homes. So this has remained. Go to the next. Retail sales activity, this is real. So if it's flat, it's keeping up with inflation. And this is through stores, pretty flat, which is to say the throughput is not very changed over the last year or so. The prices on them are changed basically in line with inflation, little up, little down. But we're still seeing okay sales. Meanwhile, go to the next, and I'm sure we're going to see this as we go through the holiday season. E-commerce sales continue upward. They have been flat, but that's because of the spurt, the artificial spurt when we shut down shopping centers and stores. I don't think e-commerce sales are flat line fundamentally so much as um, they're picking up the something like the trend, but basically 5 out of every $6 are still sold through stores. Go to the next, you see the interest rate picture. Fed has kept the interest rate way too high on the short end. That has affected the long end as well, not as much, but it's affected the long end because if I can get a government credit with a high real return by being short and liquid, why would I go into longer? So it makes the yield be higher to be competitive. As the short-term interest rates come down, it will cause some rotation out of liquid, short-term, no risk into a bit longer duration and a bit more risk. That'll push the 10-year down, I think, below 4. I think could go down to 4.5, excuse me, down to as low as 3.5 on a bounce. But and the short-term rate should be much lower. Short-term rate should be 25 bips, it should be 75 bips over inflation. Inflation is somewhere between 1.5% and 2.5%, depending how you measure it. So it should be in the at most 3.25, 3.5% range, still way too high. Go to the next, the Fed, always late. Real short-term rates are still probably 150 bips too high. As I said, inflation is running. Remember, the Fed is a terrible predictor of their own behavior. I said we're going to get 25 cuts at least next month. Um, they fail to realize that they kept the short-term rate at zero through the 2010s, and we did not get any consumer price inflation. And yet they're terrified of cutting the interest rate from an abnormally high real level by 25 bips for fear of inflation. It just doesn't make sense. There is no catalyst for inflation. The two catalysts for inflation would be rapid money supply expansion. That is not the case of what's been going on. And the other catalyst is economy-wide shortages like we had coming out of the shutdown. So whereas we had both of those in effect in 2021, 22, 23, neither of them exists. People keep waiting for prices to fall. They're not going to fall. I mean, particular items will. They're just going to stop rising as rapidly. And so you keep getting people say, oh, but prices are still high. Yes, so is your wage. They're not going to fall. They're just going to continue to grow much more slowly. If you look at the next chart, it's, I said, depending on how you measure inflation, this is consumer price inflation without one item. Just takes one item out of the roughly 80,000 items, and that's something no one has ever bought. We've talked about it. That's owner equivalent rent. That's the rent they say that you pay yourself as a homeowner. You guys are in the business and you don't know what the answer is. So how do people they ask know what they're answering? If you take that item out, you get an index of the things people actually buy. And this goes back to 2000, and you can see that today's inflation rate, net of that one item, doesn't look much different than where it's been over the entire 25 years, except for coming out of the pandemic. So inflation is off the table, although it's still very much talked about. And that's, you go to the next, you see the global supply chain um, shot up as you came out of the pandemic to something 4 standard deviations or more from normal. And it's back to normal. Normal is zero on this chart. And go to the next one, the money supply growth. And you can see during the pandemic, the money supply shot up. But the part we've circled, if you look to the right of it, it's been flat, hasn't really grown over the last 2 years. So there's no catalyst for inflation. Go to the next. Banks still have lots of excess reserves. You can see that bank excess reserves are still in excess of their peak at the end of QE3. And you saw how they ran down there. As they ran down there, we didn't see consumer price inflation. We saw asset price inflation. I think that is still coming, that as they run that down, we'll get asset price inflation, including for real estate. Go to the next. This is real crude oil price, a little below average. Now, this is a long-term average, the red. The two blue lines just mark high and low. Um, but it's around average. And the world really changed in about 2010, 2012, when fracking became commercially viable at scale. There are other things that happen, like Guyana striking oil, et cetera. But I don't see any notable push in oil prices. And in fact, you saw we went through a lot of Middle East stuff this time, and you didn't see massive movements in oil prices. You saw movements, but not massive movements like we saw in the past. And that's because we have producers like Guyana. We have Russia very motivated to produce. They have to support not only their economy, but a war. And then we have fracking. So it's a very different story. Let me come down the home stretch, Bruce, and let's just touch on real estate sectors. Go to the office vacancy rate. I think the worst is over. I think the worst has been over for about a year with hindsight. That doesn't mean it's the worst is over for every property. It doesn't mean it's suddenly wonderful. It's just the worst is over. It's like a blizzard. You get 4 feet of snow. Just because the snow stops doesn't mean you haven't got a long way to go to get back to ease of movement. No doubt, the office sector saw a blizzard. It is starting to thaw. Capital is starting to move back. You're getting law firms and other tenants taking space, but it's still a precarious sector and a long way from very healthy. Go to the next, industrial vacancy rates. Um, by standards of the early 90s, um, the industrial sector is amazingly strong. By standards of the mid 2000s, it's strong. By standards of the financial crisis, it's strong. It's just that it's weaker than it was when it was the strongest it had ever been. So industrial still has solid demand, not off the chart demand. Supply is slowed. Markets are adjusting, but you no longer have 14 tenants fighting over space. You're fighting with one or two tenants to get them in the space. But don't confuse it's worse than it was when it was at its best with that it's miserable. Um, it's still relatively strong. Go to the next, retail. Retail is in pretty good shape as long as you have good retail. If you look at the earnings reports of the public retail owners, um, and you look at the vacancy rates, things are quite good in the good properties. If it's a bad property, it's bad, and it's not likely to get a lot better. It really is a little misleading. In some ways, it's like the old industrial space that was kept on the books for years as relevant, even though no one was ever going to take a 10-foot clear space, but it was still categorized. Some of the retail vacancy, it's just structural vacancy. It's not market vacancy. And so retail doing pretty well. We're looking forward to a good holiday season. I don't think it'll be off the charts, but I think it'll be a good holiday retail season. Go to hotel occupancy. Hotel occupancy again had a blizzard from the shutdown. I mean, it's stunning how bad that was. It is much improved, but as you can see, it's still not back to where it had been. Um, Traveling is painful. It's gotten no more. The once you're there experience is good. The getting there experience is still pretty miserable and getting probably more miserable steadily. And that hits hotel occupancy, but it's recovered. It's not recovered to where it was, but it has recovered. It's no longer completely in the doldrums. Go to the next, and you have multifamily, and we'll close on this, Bruce, and have time for questions. Multifamily vacancy rates, NCREIF tends to be a bit higher quality than the census data. Um, Interestingly, both had an incredibly strong 2021, 2022, and then demand has stayed strong for multifamily, but supply spurt happened like it did in many sectors of the economy, not just in real estate. So the high prices worked, right? When the rent shot up and debt was very cheap, a lot of product got built. That product came surging on the market. Thankfully, it surged on the market when there was still demand. Wasn't like demand collapsed. So things did get absorbed. They are getting absorbed. They're just getting absorbed more slowly than people thought. As the supply pipeline shuts down, this will improve. There's a lot less being developed. I think 2027 is going to be a great year for absorption and rents into 2028. Remember, there's still a single family housing shortage, and people and home prices are up quite a bit. So people have to save longer, which means they have to rent longer before they can purchase. And so I think this sector is also, it has seen the best, but it has also seen the worst and is improved. And the reason I like these long charts, this chart's a good example. If all you do is look at the last 2 years, you would slit your wrist because you see how it's gotten worse. If you look at the longer picture, you'd say, well, it's not in such bad shape. It's kind of okay. People in it may not be okay because they may have over leveraged. People in it may not be okay because they use floating rate debt. Values may not be quite there because capital's not flowing. But the fundamental is not as bad as argued, though new properties coming online are absorbing the brunt of the market. So with that, Bruce, I think we actually finished with the promised 15 minutes that we always say we're going to leave. And we always usually leave about 3 minutes.
Yeah, you've broken tradition, Peter.
So yeah, I'm trying, this is my Thanksgiving gift to
Okay.
people is that we actually give you 15 minutes for questions.
Fantastic. Well, we have some terrific questions. A lot of attendees are curious about what your thoughts are on cap rates over the next 12 and 24 months. And maybe we use multifamily as a proxy for this answer.
Yeah, we'll use multifamily, not because we don't care about the other sectors, but it's a mark-to-market sector, right? You don't have to worry about in-place leases
Right.
distorting what a cap rate is and
Yep.
maybe big vacancy rates, et cetera. I think cap rates will improve. They have improved over the last 6 months or so, probably by 25 basis points, maybe more in some markets. They're not back to the lows they were in 2021, but they're improving. Um, I think they come in further. How much further? We simulate that the main thing that we've found, excuse me, that the main thing that drives cap rates is the flow of money. We know from a number of metrics, money is flowing well below normal into real estate. The simplest to see that is transaction volume. If you see transaction volumes well above normal, obviously it's being accommodated by a lot of capital. If you see transaction volumes well below normal, obviously capital is quite scarce and you've got a disagreement about bid and ask. We are still well below normal, um, less below normal than a year ago, less below normal than 6 months ago. Capital is starting to flow. A year ago, banks were still being told, shrink your balance sheet exposure to real estate. Today, they're being told, expand your exposure to balance sheet exposure to real estate, but do it with quality. So we're in the early phases of that comeback. We're probably, if you think of the financial crisis, we're probably 2011-ish, maybe 2012 in that capital market perspective.
Thanks, Peter. A lot of interest also naturally in interest rates. I had a meeting yesterday with somebody who had just closed on a construction loan as a borrower. If you were going to close on a construction loan in the next, let's say, 90 days, would you go fixed or would you go floating?
On a construction, I'd float. Um, I, it's hard to go fixed on a construction unless you've got some type of particular bonds or something that make it advantageous. Um, I think I'd float on a construction. On a perm, I generally want to go fixed. And you can argue, do you go fixed 5 or 7 or 10? But I would generally go fixed, including now, even though I think the rate's going to come down a bit. Um, my view has always been don't use your real estate to speculate on interest rate movements. If all you want to do is speculate, you have a view. Well, I don't mean speculate in a bad sense. If you have a particular view on interest rates, there's an easier way to bet on that view than dragging around real estate. Just use derivatives in treasuries or agencies to make that bet. And but with your real estate, my view has always been you want to lock in the deal you think you made, right? And lock in the spread that you thought you made. And uh, don't try to overthink it from a capital market point of view. And yes, you may look back and say, oops, I wish I'd have not locked it in. But by and large, I wouldn't use real estate to do interest rate speculation.
All right, thank you. A lot of attendees are also curious about why the 10-year has remained so stubbornly high. Where do you think the 10-year is going to be, let's say 6 months from now?
Well, I think it's I think it's fairly easy to understand why Treasury has stayed stubbornly high, 10-year. And that's because the real short-term rate has stayed stubbornly high. Yes, the Fed has cut the rate, but inflation has come down basically faster than they cut the rate. Now, that's not been true over the last 2 quarters, but that's a small part of the whole exercise. And it goes back to what I was saying, which is if you can get the US government credit um, at a real return with short-term investments that you would normally get only in a long-term government investment, you're going to go short. And the only way you would do the longer bond is if they bribe you in it. And the bribing you in it is they give you a higher yield than, quote, you deserve. Um, and I think that's why the long rate has stayed stubbornly high, is the real short rate has remained stubbornly high because the Fed has been, let me just say, stubborn.
Thank you. We had several write in naturally regarding AI, which is always a hot topic these days. Do you think that we're basically an AI economy now in the US?
So I've said this several times, which is asking a 74-year-old about cutting edge technology is not the smartest thing. Ask AI rather than a 74-year-old. That question might be a better way of saying it. Having said that, the only advantage of asking a 74-year-old that question is you've seen a lot of other new paradigms in your life. And you've even read about more of them because not only do you have the new paradigm claims that happen during your life, but think about it. When you're 20, you're reading about the new paradigms from 40 years earlier or 20 years earlier. So it stretches back farther. So I basically have 100 years or more of new paradigmism. And have there been some new paradigms? Yeah, I mean, electricity predated me, but home computers and internet and you can go through many other things were new paradigms in my life. But the interesting thing is none of them were overnight new paradigms. To actually get them to effectuate took time. And this is what they found about rail. This is what the studies have found about electricity. This is what they found about computers. It's not like they don't have a big impact, but it's not an overnight impact. It is a slowly seeping into the economy impact. And that's what I think is going to happen with AI. There's still lots of issues going on there. I was in a meeting the other day, and somebody made a very interesting comment um, that when you use AI at your company, it's like you getting a whole bunch of employees that you never had to do stuff. And I said, yes, but these are employees that you haven't vetted, you haven't interviewed them, and you haven't set up management guardrails on them to monitor their work. And so imagine you're a company and AI gives you the equivalent of a 20% increase in your workforce. I'm just picking that arbitrarily. You'd never increase your workforce by 20% without a lot of vetting, a lot of interviewing, a lot of mistakes, and a lot of guardrails from management. And what's happening is people don't think of it that way. And I think there's going to be some big mistakes. I think there's going to be some big successes. But actually, I think it's going to go much more slowly than people think. Um, you're going to look back and it'll seem like it all happened at once. I'm my life basically overlays television. And you sort of think about the evolution from television when I'm born to HD super smart TVs today, and it seems seamless, but it wasn't overnight. None of that was overnight. It was all slowly over time, slowly, slowly, slowly over time. And therefore, I think, yes, there's going to be things done, but just give you an example that worries me. How
Hmm.
many how many calls, Zoom calls, do you get on? This is a question to this think about. You get on and it says the call's being recorded, so you hit OK. You have no idea what's being done with that recording. None. You have no idea what's being done with that recording.
Right.
Will that show up in a legal proceeding? It's which you would not let somebody come into your meetings and start transcribing unless you knew what you were going to do with it, right? And so we're still early game, early innings here.
You have in the Linneman letter, which comes out quarterly, your famous dead canaries. What's your biggest concern? What's sort of the biggest, most evident canary in the coal mine in your opinion right now?
So there's a couple. One is we just, the Fed um, is doing everything in their power to hurt the economy. Um, Second, one of the canary categories, if you remember, is essentially really big deals being done, right? And we're starting to see, not so much in real estate, but we're starting to see really big corporate deals occurring, larger than normal corporate deals. And
Right.
why do I use that as a canary? Because when you start getting deals a lot bigger than normal, it means people had to set aside their normal benchmarks and say, okay, let's try it. Now, some of them succeed. It's not like it's awful. It's more a metric of people are willing to believe than anything else. So that's one. And the other is credit markets. Um, Not all credit markets. I think real estate credit markets, for example, pretty good shape. I think most consumer, but you are seeing on the edges of credit markets a bit of more money than brains. And I'm not an expert in, but the movement of insurance companies into active credit lending is worrisome. Um, I'm not saying they can't do it. I'm not saying they shouldn't do it. Most of them were not set up to do it. And you're starting to see cracks. And there is a phenomenon in the insurance market where the losses are not borne solely by the firm who makes them. It's borne by the entire insurance company sector. So that's a kind of distorted incentive there. So I see not like it's awful, but those are signs I see.
One of your popular comments from a webinar, I don't know, maybe a year and a half ago at this point is where do you put your get rich money right now and where do you put your stay rich money? Any updates from your
Well,
asset class picks there?
when I made that comment, I uh, I think I was right in saying I would put my get rich money in real estate, get rich money. I would put it in office because while office has still a long way to go, it had been priced as if it was at death door. And there were opportunities to death door prices differently than problems. And I think you could get in as if it was death's door when all you really faced were problems. And that's turned out to be a good get rich. I think there's still some margin there. Um, Stay rich, I still like multifamily, long-term hold multifamily, fixed rate. Um, yeah, I still like that. I I also, I think in that first time I said that, I said I was concerned about data centers. And there were a number of reasons. But one thing is the development margins are huge in data centers, and anything with way abnormal margins. Yep, people are going to make money as they're doing it. I have no doubt about that. But it ultimately brings too much supply. And you're starting to see people saying, yeah, there's all this money going into AI and there's all this money and there's a lot of demand for, but the rate of expansion, I just think is unsustainable. And there's going to be losers as well as winners. And if you happen to build a data center for a loser rather than a winner, it's going to be ugly. Or if you happen to build a spec one, I think it could be ugly. So I'm still very concerned. And I think in the months since I made that comment, you're starting to see more questioning of the breadth of the data center bed. Not, of course, there's going to be more data centers needed. That's not the surprise. It's the breadth and location and pricing of it.
Thank you. We had multiple attendees write in about the massive excess bank reserves, commenting on just the sheer magnitude there. And what's the appetite, as far as you're hearing, with respect to core lending versus opportunistic?
I think still, as the banks, I think we're at the early phase of the cycle of capital. That's why I say maybe 2011-ish, late 10, but kind of 2011 after the financial crisis. And the money comes back, but it comes back first to the strongest sponsors in the most liquid markets who can do it with the lowest leverage um, in the most transparent cash streams. And we're in that phase. And give it 6 months, you'll see it keeps creeping to be a little less transparent, a little less liquid, and the money will keep coming back because there is a lot of money on the sideline. And as that money comes off the sideline, you will see cap rates improve.
Okay, great. So we're at time here, but let's finish with one last one. What's your discount rate on the Eagles winning the Super Bowl this year?
That's a sure thing, isn't it? Um, it's a sure thing. Um, well,
So
if we
risk.
could score a touchdown, it would be a sure thing. Um, but we're having a little trouble on offense, but that'll all get resolved. And I think we're basically embarking on a strategy that says if they can't score against us, we can't lose. Tough strategy, but so far it's kind of working.
Okay. Thank you, as always, Peter. Very informative and allows us to try to make a little bit more sense of what's going on out there. Unfortunately, we can't get to all of the questions, but I just want to remind the attendees that this presentation is very much a digest of what's covered in a lot more detail in the Linneman letter, the quarterly publication from Linneman Associates. And you can find out more about that at linnemanassociates.com. And as a reminder, if you registered, you will automatically receive an email link to the recording of the webinar in about an hour. And as you said in the beginning, Peter, I too wish everybody a safe and happy holiday season. And we will see you next in 2026.
Bye bye.
Take care. Thank you.